Hello and welcome, everybody. Today we have Mike Larson, editor-in-chief here at MoneyShow, and Thomas Hayes, founder, chairman, and managing member of Great Hill Capital. Gentlemen, the floor is yours. If you need anything, I'll be right here.
Great. Thank you, Sam. Good morning to everybody who's online here. Appreciate you joining us for our Value Investing Expo. It's always interesting, we kind of plan out what we're going to talk about at different events, and it just so happens that we're hosting this one that's looking at some different parts of the market than just your traditional big tech growth stocks that we talk about, you hear about all the time. Really, this event is about broadening your horizons a little bit, looking at some of the sectors and some of the names and some of the stocks that may not have moved yet but might be carrying us down, in the back half of 2025 here and into the new year. It's been an environment where growth has again sort of captured the imagination of many investors. But I think value, when you look at the long-term trends, where ultimately some of the most successful investors over many decades focus, it's on finding undervalued names, undervalued stocks, kind of looking, where the rest of the market isn't looking. And that's what this event is dedicated towards. So appreciate you taking some time out here. We're going to give you a fantastic series of presentations, interactive, of course. I'll be, talking with Tom here as things go along. We want to make sure if you do have any questions, just type them in the chat. Let Sam know. He'll kind of read them off to us and make sure that you get everything, sort of answered to your heart's desire. Because that's really what this is all about, getting your questions answered, getting your portfolio up and running, and really having a strong finish to the year. So with that preamble out of the way, I do want to introduce Tom with Great Hill Capital. You've seen him on Fox Business. You've seen him on other television networks. If you follow Hedge Fund Tips, fantastic information on his website there. Sign up for the email newsletter. Look at the stuff he does there. Video podcasts, written commentaries. Really a ton of very valuable, very helpful information. And that focus, I guess that nickname of Turnaround Tom comes from somewhere. So, you're going to hear what Tom's philosophy is here and essentially how you can put it to work in your portfolio. So with that, Tom, welcome. Thanks for joining.
Thanks for having me, Mike. Glad to be here.
Yeah, I think, let's kind of start big picture here, top down, and look at what is it that you're seeing in this market right now. And then I think as we transition from that, we'll talk a little bit more about your methodology and some of the picks that you have for us.
Yeah, happy to do that. Basically, we've had a huge move off the lows in April. You remember probably from the Money Show and certainly from the podcast, et cetera, we were extremely bullish in the hole when people were selling hand over fist. This was a man-made correction. We figured it could be solved with one man-made tweet, and it certainly was. And the problem is you had all these managers offsides. Actually, hedge funds dumped $1 trillion of equities in the hole the day before Liberation Day. And now they are forced to play catch up. So they spent the first half of the 30-something% rally off the lows, praying for a retest. They always look for the retest, which never came. Then they had to cover their shorts. So they were the first buyers, which exacerbated the rally. And now they're really screwed because not only did they sell at the wrong time, but they didn't buy to take advantage of the recovery. So they've lost both ways, and most of them have material career risk. And people say, well, why does the market keep going up and we're trading at 22 times forward earnings? And this is part of the reason. And I don't think that structural bid is going to change into year end because there are so many managers that got caught off sides. I'll tell you who generally got it right, who's got it right since COVID, is the quote unquote dumb money has been right every single pullback and correction since 2020. And they're right again. And they made a ton of money. And I know a lot of the listeners, the Hedge Fund Tips with Tom Hayes made a lot of money buying the lows. But on a serious note, this is likely to continue into year end. So we're entering a seasonally weak part of the year, as you know, Mike, and as a lot of people know, August, September, October tends to be the volatile periods. But a lot of people are stuck with recency bias and are thinking we're going to get a big correction of 20%. And they're pessimistic with the jobs numbers and they're pessimistic with the Fed. And I think what you're going to find is that is absolutely not the case because of the conditions that I've said. And any 3 to 5% pullbacks do need to be bought because managers are going to have to be in the market.
Yeah. I'm glad you bring that up because I mean you can pick and choose from any number of headlines that sound scary and things that sound scary. You know, the Fed's behind the curve, jobs numbers are getting worse, tariffs all, are going into effect here this first period of August. How do you sort of like advise people to sort of keep their heads about them in a situation like this?
Yeah, I would say that on average for the last 100 years, we've had a 20% correction every 3.5 years. We've actually had three of those in the last 5 years, 2020, 2022, and this year intraday, 20% pullback. So we've pulled forward 10.5 years of bear market corrections into five. So what's easy to think is we've had nothing but 20% corrections. We're going to get another 20% correction now because the market's overvalued, et cetera. And I think what's going to surprise people is that we're likely not going to get a 20% correction for longer than you expect. So the 3 to 5s, yes, the probably 10% scary correction pullbacks for sure, but they will be bought. And I think the other thing to keep in mind is if you look at Magnificent Seven, and I know this has been a theme, and I know that they were impacted earlier this year, and then they bounced off the lows here in April with the catch-up trade, is the earnings growth. As good as earnings have been, by the way, the earnings were pretty solid for Mag 7, is decelerating. So last year was 33%. This quarter was 14% for the Mag 7 that have already reported. We'll get NVIDIA in August. But next quarter will be the first quarter that Magnificent Seven earnings growth actually drops below right around 10%, maybe a little bit below 10%. That's the bad news. The other bad news is that the multiples have not contracted consistent with the contraction of earnings growth contraction. So you've got, the Microsofts of the world still trading at 33 times PE with 10% earnings growth. You've got the Amazons trading at 31 times with 8.5% earnings growth. And then you shift over and you look at scenarios like small caps that are going to have 37% earnings growth in 2026 compared with the S&P 500 at 14% earnings growth. And yet the multiple for small caps, you get more than double the earnings growth for, meaningfully lower multiple. I think that's where the managers are going to be forced to buy. So put yourself in the position of a hedge fund manager or a long only manager in Boston, and you got nervous. Your clients told you to sell in April. We don't know what's going to happen with this crazy leadership, or however they phrased it, and they got it wrong. And now you've got to catch up to the benchmark, which is now back to highs. You can't buy those things that have risen aggressively. So you have to buy those things that have good fundamentals, but the price has not yet caught up. The laggards that are high quality, that are generating free cash, less so the shiny objects. Although we're still seeing that. We're still going to see that in pockets. The other thing that I'd like to say, because this is a value type of theme conference, is it's very easy to get caught in the noise right now and think you have to chase the hottest stock in the headlines. But if you step back, since 1928, value has outperformed growth by about 4%, not in aggregate, by about 4% per year compounded. Yeah. So if you had put $1 million in value versus $1 million in growth in 1928, you would have 68 million more dollars having invested in value versus investing in growth. And it's easy to get caught because right now you get a lot of guys who look extremely smart in the short term. But if you've been around long enough, they all blow up sooner or later. There are a handful of growth managers that have outperformed and continue to outperform over the long term, like the Ron Barron. But you can count it on, less than one hand. The guys who chase the shiny objects and live to tell the story. In the short term, they can have 200% years and look like geniuses because it's always the same story, which is this time it's different. The world has changed. The model is different. You're never going to that was the old days. And sure enough, in the long term, The market is a weighing machine based on fundamentals. In the short term, it's a voting machine based on emotion. So right now, you're seeing some people benefit from the short-term voting machine based on emotions, and that will continue until it stops. And when it stops extremely abruptly, versus when you own cash generative stocks, you don't worry about the short-term price fluctuations as long as the underlying fundamentals are improving and they're generating cash. Because when you generate cash, you have a huge amount of optionality. You can buy back stock, you can issue dividends, you can buy other companies, you can increase increase production where you see opportunities to earn above your weighted average cost of capital. So everything's for you, and then it's just a waiting game for when that style falls back into favor. And I think the conditions are set right now that managers are going to be forced into that style, because you can't chase things that are up trading at 100 times sales. I mean, you can do it and try to get the last squeeze out of the lemon, but good luck, because when the air pocket hits, there's no floor.
It's interesting you bring it up, and that's why I was kind of looking off to my screen over here. I've got IWO, the Russell 2000 growth's up about 1.6%, not much. IWN value down 1.9%, S&P 8%, give or take. And then you've got a name like Palantir that, as of yesterday, was up 112% year to date, 500 and something percent in the last year, and it's having another spectacular day as we do this session. So, talk a little bit more again about the rotation. Is it really just it's going to be that catch-up trade that sort of gets people out of the hot stuff over here and into the not so hot yet stuff? Is there something going else on, like macroeconomically or fund flow wise, that you're really looking for to make that pivot happen?
Yeah, I don't know that it has to be either or. I think it can be both and. I think people will want to have a little bit of exposure to the high flyers, to the Mag 7, because the recency bias is there. That's what's worked. They expect will continue to work. But I also think that if they're behind their benchmarks, they're going to have exposure to the things that are just leaving the station versus the things that have really flown. And if you look at, for instance, the Boeings, just 4, 5, 6 weeks ago, you couldn't give away the stock at $135. And we're pounding the table on Fox Business, and they're looking at me like, trying not to fall asleep. And the thing's up double in 8 weeks. And if you look at the Disneys of the world, you couldn't give away in the low 80s. And at 120, people are starting to talk about it. These are stories that are basically just getting started. And they're stories. The Generac, 75% of the home standby generator. I mean, here's a one that got down to the low 100s and now is back up to 195, almost doubles. And those are ones that we like because we can put an enormous amount of money to work and sleep like a baby at night. Like, I can't imagine having a stock trading at 100 times sales and putting 10% of our portfolio, our clients' money, into that stock and just praying every morning that the market doesn't re-rate it to 50 times sales. Even that, like, if I told you, Boeing was trading at 50 times sales or something like that, I mean, obviously the growth rates are different. Obviously these are new high flyers, but it's amazing how quickly, on the one hand, recency bias causes people to do crazy things. They extrapolate what's happened in the recent past is going to persist indefinitely. And we know, if you've been around more than 5 minutes, that these things wind up in face plants. Okay, it's just a matter of time. A great example was Amazon.com. Amazon.com in 1999 to 2000 was talking about all the amazing things that they were going to do. They were going to have home delivery. They were going to be the store of everything. You could buy everything online and it would be delivered to your house. And here's the funny thing about Amazon in 1999 and 2000. It was trading whatever it was trading, 100 times sales or one of these ridiculous multiples. Everything that they promised you that they would do, they have done. But do you know what happened over the next 3 years? The stock was down 90%. And by the way, during the period that the stock fell 90% from 2000 to 2002 or 2003, the underlying fundamentals of the business got better. It's not like it was down 90% because the sales fell 90%. The fundamentals got better. The problem was when the market wakes up on these shiny object stocks and it realizes that the growth rates may not persist forever, or even worse, everything that we expect is going to happen will happen. The problem is, wait a second, we're already paying for what we think might happen in the best case scenario 20 years from now. And when you're paying for 20 years of perfect execution, if they execute 1% less than perfection and you're already paying for 20 years, there is no floor under the stock. They're not going to say, let's stop going down when we're only paying for 19 years of future performance at perfect expectations. They're going to say, we don't know, and therefore it's sold to you at any price. And that's the difference between buying high flyers when they're currently in the news and they're shiny objects and everyone's chasing them up and it's fear of missing out, versus buying high quality businesses that are cash generative. You know, what we like to do, and the reason I got the nickname Turnaround Tom, is we look for discrepancies between price and underlying fundamentals. So we're buying, you know, we like to buy things that have come down a lot. And but the fundamentals are either still improving or in a normal cyclical trough where we can say, okay, this thing has been generating free cash for 50 years. It has a durable moat. Every 8 to 10 years, you have a cyclical trough. It's just a normal thing. They turn it around. It goes back to the mean. It reverts back to the mean. And in those situations, when you have a stock count 60, 70, 80%, and you're buying and free cash flow is still generative and they don't have any existential risk, you can get doubles and triples and five baggers and beyond very, very quickly in 3 to 5 year periods. And that's kind of, and you can sleep like a baby, because when you see these ridiculous price fluctuations on a day-to-day basis, you're like, wait a second. Did anything change with their free cash flow in the last 72 hours? Did anything change with their revenues in the last 72 hours? And you say no. And you say, would it change how you underwrote the business if you were buying the entire business yourself today?
Yeah.
Okay. And that's the whole thing. And one of the filters that we have when we buy a company is, if JP Morgan were going to finance me to buy the entire company, in other words, take it private from the public markets, the only caveat was they would put up whatever 90% of debt financing, but I had to put up 100% of my net worth as the equity. So if it worked, you know, that 10% equity piece is worth, you know, 50 times. But if it doesn't work, I lose 100% of my net worth. JP Morgan gets the business and I'm out. And if the answer is I would not take that trade, I wouldn't put up 100% of my net worth to be the equity piece, why would I ever even buy one share? And I think, you know, it's like Peter Lynch said, most people will spend 3 weeks planning their family vacation each year and be very careful about getting the best deal on the hotel, the best deal on the flight. And then they hear a stock tip on a public bus and they put 100% of their savings in it. You know, like, you can't make this stuff up. And I think and people are smart. It's just somehow when they're publicly traded and the price is moving every day, they let emotions get the better of them. And yet, if you sat them down and say, hey, you know, I heard you're thinking about buying a Jersey Mike's franchise. How would you go about valuing that?
Yeah.
And I think the average person on the street would be pretty smart. Well, I'd look at how much money it earns, and, you know, I'd pay a reasonable multiple, 5, 7 times, whatever, for private subscale business. And I said, well, what if it was losing money? Would you buy it? And they'd be like, no, why would I pay anything for a business that's losing money? I mean, unless they're like, no, I could turn it around. They run it like a lemonade stand. They have the wrong employees. Yeah, I'd pay something. But usually they'd be like, why would I pay something for something that doesn't generate any cash? And in the public markets, that's thrown by the wayside. And that's why you see, if you look on the Forbes 400 and you say, okay, who's really made money in the investment business? Okay. What you don't find is growth managers. You know, I mean, you find the Ron Barons of the world, and that's basically it. Okay. And then you look at the value managers and you go, you got Cooperman, you got Gabelli, you have Icon, you have Buffett, you have all these guys who have lasted through cycle after cycle, because ultimately the weighing machine wins in the long term. So I can't tell you whether Palantir goes to 400 times sales or 200 times sales or 100 times sales. I mean, they're doing things that are special. And the question is, and they're a great company and they have strong leadership and all that stuff. The question is, how much of the future life-changing impact of their product is already priced into the stock today? And this company could do everything that he's talking about or 10xing the revenues. Look, if you 10x the revenues, it's still trading at 10 times sales. So, if it's trading at 100 times now. So the question is, what's the right price? And no one asks that question until there's a little bit of an air pocket in the economy or in the market or in performance, or, candidly, the ones that are chasing it because it's up so much are going to be the same ones panicking out when it's down 5%. And then there'll be a different batch that are panicking when it's down 10%. And there'll be a different batch that absolutely puke it out when it's down 20%. And then there are ones that will puke it in the hole down 60%. When guys like me start to look at it seriously and take a look at it for the long term and see if there's too much blood in the streets relative to the incredible things that they're doing. So it's just a different framework. And I would say too, Mike, I think people have this scarce mindset that it has to be either or. Either you're a growth manager and that's good, or you're a value manager and that's bad, or vice versa. And I don't view it that way. I think you're going to have a guest on named Dan Ives. I think he's brilliant, and I think he operates in a different framework and a different model that works exceptionally well for him. And I like him very much, and I listen to what he says, and respect what he says and learn from what he says. But I just operate in a different framework, and I'm perfectly comfortable with errors of omission. Okay. This is what I learned from Charlie Munger. Like, when God was handing out FOMO genes, he didn't hand one out to Tom Hayes. So I'm genetically different. I don't lose a wink of sleep over a stock that's run away and going crazy that I'm not participating in. A lot of people do, because they see their neighbor, they upgraded from a Toyota to a Hyundai or whatever the hell happened. Like, it doesn't matter, because I know in the long term, the weighing machine, like, we do exceptionally well, and following our framework and staying in our lane and sticking with our knitting. And I think that people have to get comfortable. Maybe you're genetically wired to be a growth investor and just do it better than anyone else. You got William O'Neill kind of set the framework. Subscribe to Investors Business Daily, buy the book, How to Make Money in Stocks, and you can be a growth investor. If you want to, if you think more business-like about why you buy a piece of a business is for a piece of the future cash flow, then you're probably genetically wired to be a better value investor than a growth investor. And it doesn't mean you're different. It just means, like, one of my daughters loves chocolate, one loves vanilla, and it's never going to change. That's just how they're wired. So accept it, and one's not better than the other. It's just a different framework. And if you want to win at one framework, listen to people who are really good at one framework. Don't listen to me about how to buy the next Palantir. Listen to me about how to buy Generac when it's down 70%, even though it's got 75% of the home standby generator market, and it doubles over a couple of years.
Got it. And I want to leave plenty of time for you to talk about today's picks, but if anybody's listening to this, I do want to point out, I mean, Tom highlighted some of the names that he's been in even longer than he's talked about them at Money Show events. But on my screen here, just year to date, for example, Generac up to about 27%, Boeing up about 26%, Advanced Auto Parts was another name up 15%. And again, these are names that he's been in for a lot longer. So understand the profit potential is there if you get the timing and the price right, even not just relative to the market, but relative to some of these great growth names that get the headlines, but the sort of, behind the scenes you're making, again, if you get into these value names at the right point, the profits can be phenomenal. So it's not just
by the way, it's not even that. It's yes, buying the stocks down and then waiting, our average holding period is 12 to 48 months. So you can make quick doubles and triples, quick meaning on average 36 months, which is, an IRR that exceeds the S&P 500. But when you buy companies that have such predictable cash flows when the price is down, we do a derivative overlay in a small bucket of the portfolio, and that adds such extreme returns without taking meaningful risk to these names because they're so predictable for us. So if the stock price goes up, 50% on a small bucket, we can have expected value on different spreads of 5x on that boring sleepy name. And so it's kind of like it's nuanced because it's not just these slow doubles and triples. It's how we're able to express it for clients that makes boring stocks with predictable and sleep well at night incredible returns over time.
Got it. Well, let's talk about one of the names that I know you've mentioned before, but I mean, you're still a fan of it. It's something that I think is appropriate for this audience that is talking here, and that's Cooper Standard, auto parts supplier, correct?
Yeah.
What's the story there? Why has it worked so far? And why do you think there's more to come in a name like that?
Yeah, Cooper Standard. So they reported on Friday. They took up their guidance. They took down the industry estimates of annual production. So they're very levered. We got this idea from Charlie Munger, did a similar turnaround situation in the recession of 2001 to 2003. Company named Tenneco. They were an auto parts supplier. Maybe you remember them. They were down 90-something%. They had $1.1 billion of debt. They had to refinance it. People thought they were going out of business. Buffett bought it at $1 and change. They refinanced the debt. He got out a year and a half later at $15. It subsequently went on to $35, but error of omission, no big deal. And so we looked at this COVID situation. We're like, what's the most dislocated businesses that we could maybe replicate? And we started looking in the auto parts suppliers, and we found a company called Cooper Standard. This was May of 2022. And Cooper Standard, same story. They had $1 billion they had to refinance. They have refinanced a lot of that out to nothing to deal with until 2027 and then later in the decade. So we built a position in May 2022 in the fives. Okay, $5 and change. I think today it's $20, $25, something like that. So 5x on the bulk of it. We've added clients in at 10. We've added clients in at 13, 14, $15, et cetera, as they've come in later and later. This is a simple play. This is a business with huge operating leverage. They do sealing systems around the doors and windows, that rubber stuff that goes around, fluid transfer systems, very boring. And it's a leverage play on the recovery of US SAR sell-through, the number of units sold, okay? And if you go back 50 years, despite the fact that the population was a lot less 50 years ago, maybe 220 million versus 330 million, every single cycle peak came in between 17.1 million cars and 18.5 million cars, going all the way back to 1980. We got down to 15.1 million cars at the trough of COVID, okay?
Yeah.
And we're still not yet we're in like the mid 15s to high 15s. And part of that's been high rates. Part of it is cars last longer. Part of it is the demography, but all of those things are coming back together, okay? Number one, we got a 90.4% chance of a cut in September as of this morning. Rates are coming down. The car volumes are starting to come back. The average car on the road is 13.5 years. And this was a $146 stock at the last cycle peak when SAR was over 17 million in 2017. They earned $7.19 in 2017, and the stock traded at 146. We bought it at 5. They refinanced the debt. It quickly doubled. The volumes have not yet recovered. We believe, based on the amount of costs that they've taken out of the business, hundreds of millions of dollars of costs, that when the cycle volumes, they don't even have to go back to 17 million, which they will, by the way. Most people don't think they will. Even at 16.5 to 17 million, this business is not going to earn $7 a share because they've become so much more efficient. We think it can earn $10 a share. So if it traded at 146 at $7.19 of earnings, call it 20 times earnings, at $10 earnings, the question is, what multiple does the market apply when we hit the next cycle peak, does it apply 10 times? Then you got $100 stock, in which case it would be 20 bagger off of our initial basis, 10 bagger off of some of the later people that came in. If you get a 20 times multiple again, a peak multiple, you could have a $200 stock. Is that our base case? No. But would it surprise us if we wind up with a blended 20x, 15, 20x, 25x on it? No. And this is something that's very easy. We don't have to predict, is someone willing to pay 150 times sales versus 125 times sales and just gamble there will be people coming in buying us? I mean, it's a very simple formula. At 10 times earnings, it's not going to be hard to attract a lot of buyers. At 15 times earnings, if they're generating 10 bucks, it's not unrealistic to think it could trade to 150 to 200. And if you're skeptical, cut it in half. You still have a triple from these levels, which, over a 3-4 year period is a pretty attractive scenario. So nothing is perfectly without risk, but we try to minimize risk and cover. I was taught, number one, never let them take you out on a stretcher. That was my first boss. Okay. So, and number two, if you protect the downside, the upside takes care of itself. And that's what we try to do every day, is sleep every night, underwrite it as if you're buying the whole company. And if you're not willing to buy the whole company with 100% of your net worth as the equity, don't buy one share. You don't have to be involved in everything. You can actually read headlines, be happy for the people who are riding the Momo stocks, hope they make a lot of money, and not participate. And, or if that's what you like to do, participate and then watch it very closely, because when it turns quickly. And if you don't like golf and you like to spend 24/7 in front of screens, then you could probably make some money that way. But, I like to have a balanced life and I like to buy good businesses. If you own 10 franchises, you're not sitting at a screen watching the cash register things tick up and down and saying, oh my gosh, receipts are down 8% in the last 60 minutes. I better sell that franchise. It's that's just not the way it works. And candidly, that's why, a lot of my clients have made, fortunes, hundreds of millions of dollars in real estate. I think part of the reason a lot of people become wealthy in real estate is because they don't have daily liquidity. Yeah. I think if they did have daily liquidity, they'd be in a lot of trouble. That, and they have a lot of leverage in real estate, and they pay no taxes. So those three things are helpful. But there have been plenty of people that, there's the old saying, if you want to become a multimillionaire, get into real estate, buy real estate. If you want to become a billionaire, buy businesses. And you've seen that from the Icons and the Buffetts, and the Coopermans of the world and some of the private equity guys, et cetera. So we just try to underwrite it as if we were buying the whole business. And if you operate from that framework, I think you're going to be very happy. I think in the short term, it's kind of the tortoise and the hare. In the short term, the hare is going to look really good and be winning the race. And then all of a sudden it falls flat on its face because it runs out of gas and the air pockets come and the turtle just walks right by because he just plods along doing his thing. It doesn't get distracted, doesn't look this way, doesn't look that way. And sure enough, they wind up with the gold medal.
I definitely want to leave time for your next pick. It's kind of an interesting name when I saw you come through in the energy space. But before I do, just briefly on Cooper, tariff issues, anything that's going to mean for this company's business, the way you look at it?
Yeah, they've addressed that in the recent conference calls, and that's another important thing is if you own a piece of a business and you're not listening to the people you've hired to run that business for you, which is the managers, you're really missing out. I mean, we go through every earnings call transcript with literally a fine-tooth comb, our weekly articles we cover, we underline literally word for word the most important things they said. And you miss that nuance. And some people try to get cute with AI and they say, summarize the call, and you really miss how they were saying it. And sometimes listening is better even than reading, because you can get a sense of the nuance and really, it's like if I'm having a conversation with you and you say, I'm really excited about Palantir, or you say, I'm really excited about Palantir, it's going to show up the same in the transcript, but you could say, I don't know, he seems like he's not excited, or he's like super excited. I better look into this. So missing that nuance is kind of, it's a little old school, but there's a lot of value to it because you got human beings running your business. One day we'll have humanoid robots and maybe it'll be different, but for now, missing that nuance can be very, very, you can leave a lot of money on the table doing that. So we try to focus on that. What was the question?
Oh, sure. Just briefly, tariff impact on
Oh
them
yeah,
and
so
their
so
business.
they've been able to dramatically minimize that. A lot of it, they're not shipping cross border; they're shipping to factories within where they produce within the countries that they produce. So it becomes the OEM issue. It becomes the Ford and the GM's issue more than the Cooper Standard. It's not without impact, but they've really meaningfully minimized it, and it's priced in at this level, and it's not going to ultimately have meaningful impact on the volumes, because at the end of the day, you still have the average car on the road 13.5 years. They break down, they get scrapped after a while. So I think the big thing, the number one driver of volumes, forget about looking at Cooper Standard, forget about all I'm looking at is incentives. And if you look at the industry incentives on cars, meaning just go watch a football game, are you seeing more ads that say 0% financing or 2.9% financing? Or are you seeing less ads? The answer is you're seeing a lot more ads. And that's not great for the OEMs, because their margins are going to contract. It's going to be a race to the bottom. They thought they could get away with this controlled scarcity that they got away with during COVID, where they could sell the Escalades at 20,000 above MSRP. That game is over. The Koreans are coming in. If the US producers aren't going to provide volumes, the Koreans and the Japanese are. And therefore, it's a race to the bottom. We're going to see huge amounts of volumes, which benefits the Cooper Standard and other auto suppliers. It'll help their volume numbers, the OEMs, but their margins are going to contract because the incentives are going to go up. The more the incentives go up due to competition, the bigger the volumes, and we get paid per car. And that's where we really benefit. So if you look through these cycles, the number one indicator of where volumes are headed are incentives, and the incentives have been going up in a straight line for basically the past 12, 13 months. So it's early days. It usually goes for 36 to 48 months. And that's where you get that huge operating leverage kick in, and huge profits to the bottom line.
Got it. Well, let's move on. Energy services, oil field services, if I can get that out there. That's one of your names. Talk a little bit about this other idea you brought to the table.
Yeah, so we're trying to figure out a way. We still have a company called Comstock Resources, which is natural gas. We want to have energy exposure, partially because it's out of favor, partially because of the energy policies of this administration. Now, if you look to Trump 1.0, energy stocks actually did poorly because, increased production reduces profitability. So how could we benefit from this change in policy without being as sensitive to the price of the commodity? And what we came up with was oil field services. National Oil Well Varco, as they used to be called, now they're called NOV Inc., is a leader in OEM in onshore and offshore drilling rigs. They not only produce them, they service them. They have the largest install base, the largest share. So I think what you're going to see, we're probably at or near the trough in terms of rig count. As that starts to tick up, their operating leverage is huge. And usually with these energy companies, they have levered balance sheets. And in the case of National Oil Well Varco, they got $1.2 billion of cash. They got $1.7 billion of debt. They're generating $1 billion of free cash flow per year in kind of the worst part of the cycle. So we don't have to worry about whether they're going to be here. And we, as a leader in what they do, again, the operating leverage is enormous. So even if the rigs tick up just a hair, the money that's going to go straight to the bottom line with 50% install base is going to be staggering, and it's going to make $1 billion of free cash flow look like nothing. They'll be generating $2 and $3 and $4 billion, and you're going to have a stock that goes from $12 to $40, $50 over the next few years, in our opinion, not advice. And these are the type of things that we look for. Our downside's protected because their balance sheet and income statement is solid. They're generating a ton of free cash flow to service the small amount of relative debt that they have, and they're doing it in the worst operating environment. So two things that happen. Number one, drilling happens more when the price of oil goes up. And number two, which people aren't thinking about, drilling happens more when the cost of leverage goes down. Most of these E&P companies have levered balance sheets, so if they can refinance at lower rates, which we expect will be the case in the next handful of months, that changes the economics to the prices that where it becomes profitable to drill based on their cost of capital. And they're going to want to take advantage of the policies in place to get more rigs in production ahead of the risk of a different type of regime coming into play. Get it in now, get it going, even if it's at break even or slightly unprofitable. And NOV will be there to provide them all the services that they need in order to make that happen, both onshore and offshore. So we love that. We looked a lot. If you look at the underweight positioning of managers, et cetera, we're trying to find ways to express that in energy. And candidly, I don't think enough of the E&P companies have come down in price enough relative to the price of crude, how much that's come down. So I kept looking at the underweight and seeing that there just wasn't any opportunity there wasn't enough margin of safety in the exploration and production names. In the servicer names, I see huge opportunity. So even if the price drops more with a company like NOV Inc., the margin of safety is such that I don't have to worry about it. And if it goes against me before it doubles and triples, we'll buy more.
Got it. But listeners, if you're watching this, you have any questions, now's the time to type them in, get a chance to get a few of those answered before we're done. I actually saw one question come through, and that's Tom. This one says S&P's up about 7.5% year to date. And I don't know if you want to sort of take a macro opinion. Where do you see it going for the remainder of the year? And the second part of the question was, do you actually have a price target for a name like Generac or Stanley Works, SWK?
Yeah, so Generac, Stanley Black & Decker, and QXO, which is Brad Jacobs' roll-up of building supply, is our theme for our housing recovery play, and that's going to be a function of rates coming down over the next 6 to 12 months. So in terms of our price targets, we don't publicly say them, but I would say for Stanley Black & Decker, it's at least double from here. Generac's got more gas in the tank. For sure, mid 200s will probably be fully out, mid to high 200s. And we'll trim some along the way, et cetera. QXO is just getting started. That's going to be an 8 to 10 year roll-up play. That probably goes to $80 to $100 plus with Brad Jacobs. That guy knows how to compound capital. We got in at $12 and change. It quickly went on the beacon. It doubled to 25. Now I think it's at 20. So that could be a 4-bagger over the next 6 to 8 years from these levels, maybe 5-bagger. And he tends to underpromise and overdeliver. So he'll probably have some rabbits he pulls out of the hat. He's an awesome. So we look for these themes, and what you can see from the themes is we buy when they're out of favor, when they're not in the headlines, when people aren't talking about them, and we sell when they start to be in the news every day and become the new shiny objects of tomorrow, and people can't get enough. We help them out and lay off the shares. As far as the S&P 500, look, we're in a seasonally weak part. It wouldn't surprise me to see 3 to 5% pullbacks, consolidate some of the gains. But I think we resolve higher into year end. So it wouldn't surprise me to see us, if we go back to 62, 6,100, that we don't finish the year at, 6,600, 6,650, 6,700 type of thing, because you still have 14% earnings growth next year. You still have a lot of opportunity on the surface. I do think if you're exclusively in indices or the companies that have already moved a lot or that everyone's crowded into, I think you're going to underperform. This goes back to the conversation. It's not an either or, it's a both and. Mag 7 can go up from here. I think they will go up less on a relative basis than those laggards that people have to chase to catch their benchmarks and keep their jobs, and those stocks that haven't moved as much that are going to be the leaders for the second half of 2025. So that's how I would think about it. So it doesn't mean you have to get out of one set of companies just because the others. It just means you might lighten up a little bit one group and start to add some of the other group that you're underexposed.
Got it. A question on NOV just came in. Actually, it says, do you think if oil drops to, say, $50, then do you think the technicals will push the riskless or fundamental price much lower than 13?
I could care less. We'll be buyers. I hope oil falls to 40 and we can buy a ton of stock at $8. Because if I look 3 to 5 years out, I've got, $40, $50 stock. So if I get to buy more at 8, I'd be super happy about that. I don't think about or even worry about the short-term voting machine based on emotions or $50 oil. I think that benefits National Oil Well Varco as a leader in what they do. It would hurt its competitors more than it would hurt it, because it's got the strongest balance sheet, it's got the greatest expertise, it's got the highest install base, and their business profitability is less dependent on the price of oil because of the existing install base and the servicing. So it's not without risk to the price of oil, but it's lower risk, which is why we chose to express our interest in out of favor energy through this particular company, because of accounting for the possibility of lower oil prices in the short term.
Got it. Well, I think that's the last question that I saw come in, and my watch is about to say we're kind of at the end of our time here. But Tom, thank you so much, honestly, for joining in this discussion. Viewers, if you're listening to this, again, check out Hedge Fund Tips. Check out some of the work Tom does. You'll see him on TV as well, talking about just a different way of thinking about investing. Really thinking about the types of investors that have won long term, that have those track records. It's in the value space, and he's got the numbers to prove it. So, Tom, thank you so much for sharing your insights and your picks, and look forward to talking again in the future.
Appreciate it. Thanks so much, Mike.